Imagine waking up tomorrow morning, checking your brokerage account, and seeing $2,900 in fresh dividend payments, money that arrived while you were sleeping. For most Americans, this sounds like pure fantasy. But what if I told you thousands of ordinary investors are already living this reality? Today, I'm revealing the exact blueprint for generating $2,900 in monthly dividend income without needing a seven-figure portfolio to start. By the end of this video, you'll understand precisely how to build a dividend machine that pays you whether markets go up, down, or sideways. So let's dive into what could be the most important financial video you watch this year. But before we get into the advanced strategies that can dramatically accelerate your dividend income, let's make sure we're on the same page about what dividends actually are and how to evaluate them properly. Think of dividends as your share of a company's profits, paid directly to you as a part owner of the business. When you own stock in a dividend-paying company, you receive regular cash payments, typically every quarter, without having to sell a single share. This creates the ultimate passive income, money flowing into your account while you focus on what matters most in your life. However, not all dividends are created equal, and evaluating them correctly is crucial for your success. There are three critical metrics you need to understand: dividend yield, payout ratio, and growth rate. Dividend yield represents your return from dividends relative to the current stock price. It's calculated by dividing the annual dividend by the stock price. For example, if a $50 stock pays $2 in annual dividends, its yield is 4%. While higher yields provide more immediate income, they often come with greater risks. The market average historically hovers around 1.5 to 2%, so yields substantially above this deserve scrutiny. This brings us to the second critical metric, the payout ratio. This reveals how much of a company's profits are being distributed to shareholders versus retained for growth. A company earning $4 per share while paying $2 in dividends has a 50% payout ratio, generally considered healthy. When ratios exceed 75 to 80%, the dividend becomes vulnerable to cuts during economic downturns or if company performance deteriorates. And here's where most dividend investors go wrong. They focus solely on finding the highest current yields without considering sustainability or growth potential. This approach is like buying a car based only on how fast it can go, without checking if it has enough gas to reach your destination. This leads us to perhaps the most important metric for long-term income growth, the dividend growth rate. This shows how rapidly the company increases its payments over time. A company consistently raising dividends by 8 to 10% annually will double your income approximately every 7 to 9 years without requiring additional investment from you. Now that you understand how to properly evaluate dividends, let's talk about what really makes dividend investing work over the long term. What I call the secret sauce that creates truly life-changing dividend income. The true magic of dividend investing isn't in the initial yield. It's in the powerful combination of consistency and growth that creates an unstoppable income-generating machine. First, let's talk about consistency. The most successful dividend investors don't chase the latest high-yield trend or jump between different stocks hoping to maximize immediate returns. Instead, they build positions in rock-solid companies with proven track records of paying dividends through recessions, market crashes, and economic uncertainty. But consistency alone isn't enough. You also need growth. A dividend that increases by 7 to 10% annually might not sound impressive initially, but the compounding effect over time is nothing short of remarkable. A $3 annual dividend growing at 8% becomes a $6.48 dividend in just 10 years, more than doubling your income without buying additional shares. When it comes to finding that perfect combination of consistency and growth we just discussed, one group of companies stands head and shoulders above all others, the Dividend Aristocrats. These elite businesses have increased their dividend payments for at least 25 consecutive years, a remarkable achievement that demonstrates exceptional financial strength and management commitment to shareholder returns. Think about what this track record really means. These companies have raised their dividends through multiple recessions, market crashes, technological disruptions, and changing consumer trends. The S&P Dividend Aristocrats Index has historically outperformed the broader market with lower volatility, delivering that rare combination of higher returns with less risk. This outperformance stems from fundamental business quality. Companies can only achieve aristocrat status through consistent profitability, disciplined capital allocation, and sustainable competitive advantages. The inflation-fighting power of dividend aristocrats is particularly valuable in today's economic environment. While inflation erodes the purchasing power of fixed-income investments like bonds, aristocrats typically increase their dividends faster than inflation, ensuring your income grows in real terms. A company raising its dividend by 7 to 8% annually will double your income roughly every decade, regardless of what happens to the stock price. For investors building a dividend portfolio from scratch, allocating 40 to 60% to dividend aristocrats creates a rock-solid foundation. Their reliable income growth provides incredible long-term stability, but there's still one challenge. Most dividend aristocrats have yields in the 2 to 3% range. While their growth is impressive, many investors need more income right now. And that brings us to covered call ETFs, perhaps the most exciting dividend strategy available today. One that can potentially triple your current income without requiring additional capital or excessive risk-taking. Covered call ETFs, boosting income. These innovative funds combine traditional dividend investing with option strategies to generate yields that often range from 7 to 12%, multiples higher than the market average. A covered call ETF starts with a portfolio of high-quality, dividend-paying stocks similar to what you might select individually. But here's where the magic happens. The fund managers sell call options against these holdings, collecting premium payments that significantly boost the overall yield. These premiums are then distributed to shareholders alongside traditional dividends, creating a powerful dual income stream. How does this work in practice? Let's break it down. When you sell a call option, you're giving someone else the right to buy your shares at a predetermined price, the strike price, within a specific time frame. In exchange for offering this right, you receive an immediate payment, the premium. If the stock price remains below the strike price, you keep both your shares and the premium. If the stock rises above the strike price, you might have to sell your shares, but you keep the premium plus any appreciation up to the strike price. Popular funds like JP Morgan Equity, Premium Income, ETF JEPI, and Global XS&P 500. Covered call ETF XYLD have attracted billions in assets by offering yields of 7 to 12% paid monthly, a game changer for income-focused investors. For someone with a $500,000 portfolio, this could mean generating $35,000 to $60,000 in annual income compared to just $10,000 to $15,000 from traditional dividend stocks. The primary trade-off with covered call ETFs is potentially limited upside during strong bull markets. When stocks surge dramatically, these funds may underperform because their upside is capped by the call options they've sold. However, for investors primarily focused on generating current income rather than maximum growth, this is often an acceptable compromise. These funds work particularly well in sideways or moderately bullish markets, where they can deliver superior returns through their enhanced yield while still capturing some price appreciation. During market downturns, they typically offer better downside protection than pure equity investments thanks to the income cushion provided by option premiums. Building your $2,900 monthly dividend machine. Now that you understand the power of both dividend aristocrats and covered call ETFs, let's put it all together into a practical strategy that can generate $2,900 in monthly dividend income. The ideal approach combines the high current yield of covered call ETFs with the reliable growth of dividend aristocrats. This balanced portfolio gives you the best of both worlds: substantial immediate cash flow plus a growing income stream that protects against inflation and expands your future income. Here's how a $400,000 portfolio might be structured to generate approximately $2,900 monthly, $35,000 annually. First, allocate 60% $240,000 to covered call ETFs, yielding approximately 10% annually. This portion of your portfolio provides the heavy lifting for current income, generating about $24,000 per year or $2,000 monthly. Next, allocate 40% $160,000 to a diversified basket of Dividend Aristocrats yielding around 2.5% but growing at 7 to 8% annually. This provides approximately $4,000 in first-year income, $333 monthly, but will steadily increase over time. Additionally, selectively reinvest a portion of your covered call ETF income into more Dividend Aristocrats during market corrections. This gradually shifts your portfolio toward higher quality, growing dividends while taking advantage of market volatility. The remaining $7,000 in annual income comes from a small allocation to specialized high-yield investments like mortgage REITs or midstream energy companies. While these carry higher risks, a careful selection of the strongest players in these sectors can provide substantial income to round out your dividend stream. This balanced approach delivers approximately $2,900 in monthly income from day one, while still positioning you for future income growth. Over time, the Dividend Aristocrat portion of your portfolio will generate increasingly significant income, allowing you to gradually shift more capital from high-yield investments to growing dividends as your income needs evolve. The real beauty of this strategy is its adaptability. Those needing maximum current income can increase their allocation to covered call ETFs, while those with longer time horizons might weigh more heavily toward Dividend Aristocrats. Either way, you create a sustainable income stream that can support you through any market environment. An important note about taxation: hold your covered call ETFs in tax-advantaged accounts like IRAs whenever possible, as their higher turnover and income can create tax inefficiencies in taxable accounts. Dividend Aristocrats, especially those qualified for preferential dividend tax rates, often work well in taxable accounts for investors in lower tax brackets. The most dangerous mistake when implementing this strategy is chasing unsustainable yields. When you see dividend stocks offering 15 to 20% yields, this usually signals distress rather than opportunity. These dividend traps often lead to painful cuts that devastate both your income and principal. Stick with proven covered call ETFs from major providers and Dividend Aristocrats with decades-long track records of reliability. So, there you have it. The fastest way to generate $2,900 in monthly dividend income without requiring decades of waiting or a massive starting portfolio. By strategically combining covered call ETFs for current yield with Dividend Aristocrats for growth and reliability, you create a powerful income machine that can support you through any market condition while still growing over time. Most people watching this video will find the information interesting, but never take action. But I believe you're different. If you're serious about building dividend income that can transform your financial future, hit that subscribe button right now and turn on notifications. Then drop a comment below with your current monthly dividend income and your target. Remember, financial freedom doesn't happen by accident. It's the result of specific strategies implemented consistently over time. The action you take today could be worth tens of thousands in passive income for years to come.